Hey everybody, it's Bob with Trade Genius. Got my good friend Phil here. The market and the economy are not the same, but one leads the other. We're going to explain to you what's happening, and you know it's not bullish. Stay tuned.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Use promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening. Okay, Phil, I hate the unemployment report as a proxy for economic success. I've always been a big fan of how much tax revenue is coming into the coffers, because that's a better judge and gauge of economic activity. You found a couple really cool charts. I'm going to throw it to you, and then I'll give you my opinion after you lay out the scenario for everybody.
Yeah, so best thing to do is just explain the chart we're going to show, and that is here where basically whenever tax receipts start to fall below that 2% annual growth rate, get a recession like every time. So this chart here kind of visualizes where we're at, and it's not pretty because here we are, that dashed line's kind of that threshold for that 2%. You really don't want to be below that. And as you guys can see on the chart, when we do get below that line, we get these gray background, these gray bars, these vertical bars. Those are all recessions. Okay. So here we are again, except we got a really deep dive this time on tax receipts. So as Bob was saying, that's a pretty good economic indicator of what's going on. And the market sometimes gets detached or actually has a final squeeze. And if you look back at all-time highs, even before recessions, you're pressing up into new highs in the market, and a lot of times you'll just get a final blow off because people could be trying to short too early. There's a bunch of different reasons. I think, as I've explained in other videos, it's a great spot for institutions to get really short the market and maximize profits on the way down, because nothing better than making money as the economy is rolling over because you bet against it, right? So I think it's something that happens over and over and over again. They time it against the economy rolling over, because most of the time these institutions are positioned long. That's where all your big money is, but you can make a ton of money really fast if you catch that timing as things roll over. And so I think that's what's setting up here, Bob. But again, we're in a really, really deep negative reading on tax receipts here. And I think that's just, foretelling the inevitable here.
Yeah, and you guys got to remember, we have a progressive tax code. So what it's telling us is that, either people are unemployed and aren't paying federal taxes, or they're overemployed but not making any money. And so, and the other thing that's even scarier is that most of the money is made with capital gains, Phil. And we were talking in a room, I think we even did this chart with you guys last week, is that the S&P 500 is at all-time highs, but the median stock price from the last time we had an all-time high is down almost 10%. That means a lot of people are throwing capital losses out there. The last time the government had a surplus was in the year 2000 tax year, when we had all that crazy .com stuff. That's what a bull market looks like. It creates these massive tax receipts from people selling out their overvalued stocks. Well, what's happening this time is there's a lot of losers out there, and so we're getting a situation where they're not getting the tax receipts, and economic activity is starting to grind down. So I think this is a big issue, and it's going to get worse. Look at how far it can plunge. And now the government, all the states and everything that can have to borrow, and they're borrowing at a higher interest rate. So it's like a twofer against them. So I don't know. I want to throw that out there, you guys. This is not good news. And if you're long the markets and you just happen to be in the top 7 stocks, you guys are absolutely geniuses. You made a lot of money. But for the 99.5% of the people who haven't beat the S&P 500 this year, you're miserable, and you're going to get more miserable if you try to stay long the market. So Phil, you have an air chart. This is pretty cool. Yeah, this is what we talk about. I want to show this on Saturday, and I forgot to send it over to you. Look, this is what I'm talking about, guys. The trolls are always talking about the blue line at the top. The rest of the world's sitting in flatland.
Yeah, if you look at this chart, whenever this starts to get crazy divergent, it usually leads to extreme volatility and some pretty decent drawdowns. And you can see that as we got into, going through 2021 and stuff like that. And so this isn't a sign of health because it's unsustainable. And I think you and I were talking about how a lot of people, even in our clients, where their 401ks are sucking wind because what 401k or what plan that any of these institutions come up with for 401ks stick you in 7 stocks. They don't do it. They spread you out in different sectors. There's moderate growth, mild growth, aggressive. Even the aggressive growth stuff doesn't put you in 7 stocks. So that's all you hear about is the Magnificent Seven. That's primarily why the stock market is at all-time highs. But whenever you look at when you would have a situation where the stock market drops precipitously, it's usually because the underlying breadth really stinks. And that's the situation here. It's just a high concentration of 7 stocks propping everything up. And so unless the economy's really humming along, you tend to get this because the 401k flows aren't really going into the rest of the market. I think that also exasperates the situation. So it just becomes this high levered betting environment where the funds are really starting to try to outdo each other. And really that's because the only thing performing left is the last 7 here, and that's your basically your city of refuge for alpha, and then the whole thing implodes.
Yeah, and it's funny, Phil, because you're from Hawaii to City of Refuge. Not everybody can get in there.
No. And if you don't make it, you die.
Yeah, you die. So, yeah, guys, look, I mean, this is not good news. We've seen this before, and it's going to end badly, and there will be a reversion to the mean here. So just be careful, and if you're a trader and you're doing well on this thing, God loves you. But we had a conversation this morning in our room with our VIP clients, and guys that said they went to a whole bunch of different trading places, before they found us. And I'm not talking humble brag here. What they're saying is that people even to try to chase this fast moving stuff can't do it. So it's just almost like impossible. It's like we're seeing a movie, that we can never join. But what'll happen is people will start trying to chase this stuff. You're going to get explosions on the downside. So we haven't changed course. We're hedged now, and we're going to wait and see what the next 2 weeks has on offer. And I'm a little bit more bearish than Phil is. So we'll see how this all plays out. But I think it's going to be a pretty interesting next 6 weeks, Phil.
Yeah, one thing I'll leave you guys with, I think there's some misunderstanding in terms of how this thing rolls over. And we hear a lot about when's the 20 to 30% drop going to happen or crash going to happen? And most likely it doesn't crash. What'll happen is week after week after week, you start to just kind of roll over. And if you notice from previous market tops, you'll just get distinct lower highs in the market. So it seems a little misleading because it doesn't seem like things are falling off a cliff until maybe the 3rd or 4th or 5th week of down. And then all of a sudden things start to accelerate a little bit more to the downside. Then you get these wild rips higher. So it won't be a crash, I think, until sometimes toward the end of a bear market, you do get a capitulation and then it does feel like everything's just crashing at once. But be of the mind that things will take time to roll over and that, 20 or 30% may take a few months to play out, which is the most likely scenario. But for me, I don't know about you, Bob, but for me, I think jobs data is really the missing component here.
Yeah, and I think they need to talk about both these things and the thing about the job market, look, I was in the payroll business. So these payroll companies are actually, they're involuntarily debiting these companies' account. It's not like people are holding off paying the federal government. You get, that stuff gets withdrawn out of your paycheck. The employer side gets pulled, usually the average, pull is 1.5 days, counting all taxes, right? So this is like pretty up to date, what's going on here. We'll have to see now. The 15th just showed up, that people have to pay their next quarterly, but I'm not holding out hope. I live in California. They swung from a $100 billion gain to an $80 billion loss in 1 year. And I think we're the canary in the coal mine because we represent a lot of that cap gain money, that gets generated, and it's just not showing up. And I think that's a big issue.
Totally agree. Guys, let us know how your 401ks are performing. Kind of curious to see what the audience has to say in that regard, because it sure seems like a lot of us aren't seeing the gains that the stock market is supposedly giving. So let us know your thoughts on that below in the comment section. Otherwise, guys, thanks for watching. Please hit like and subscribe. Check out our stuff over at Trade Genius if you need help navigating these markets, and we'll see you guys on the next video. Take care.
Trade Genius.